The Real Investment Show.
Welcome back. So this morning at 6:17 as we get this Thursday edition of the Real Investment Show underway. Realinvestmentadvice.com, our latest blog posts are up. Mike Lebowitz, CFA, joins us this morning. He's got an article up on the website yesterday talking about, can the Fed actually step on the gas and the brake at the same time? This is going to be kind of an interesting thing. As I opened up the show talking about yesterday, Jerome Powell was speaking. And he talked about the fact that the unemployment rate was actually probably closer to 10% than it was to 6%. And this is something you and I have talked about before. We've written articles about this, is that, you know, while you talk about the Bureau of Labor Statistics and their employment survey, it really doesn't give you a good representation of what's going on in the actual employment market when you have such a low labor force participation rate. And that labor force participation rate has been continuing to decline since 2000. When we hit our peak in labor force participation, and that was after 2 decades of labor force participation rising, right? We had more and more people participating in the labor force. It's been declining for 20 years. Right. And we get more and more people sitting outside the labor force, and this is why, again, we see a lot of angst. You know, we see a lot of, riots and people, angry about the wealth gap, because this labor force participation is a problem. And now more than ever, we saw, in March when we had the shutdown, we had all these layoffs that were supposed to be temporary. Now they're permanent. And so yesterday, Jerome Powell addressing this, saying, hey, you know what? There's these employment numbers we get may not be as good as they look, actually, because of the fact we've got such a large number of people sitting outside of the labor force. And again, even when you look at the weekly unemployment claims, we're clipping off 1 million people a week between the actual state unemployment claims and the pandemic unemployment benefit claims. The highest we had in terms of unemployment claims ever for a recession was 687,000, and we're doing 1 million a week. So right. It definitely tells you there's something wrong in the economy. So what do you think about what he was talking about yesterday? What was your first impression?
So I agreed with him. He's 100% right. The unemployment rate is not 6.3, 4%, whatever they say it is. It is close to 10%. And the Bureau of Labor Statistics gives us those numbers, right? They put out about 6 or 7 key data points when they put out the Friday employment report on the first Friday of each month. Mm-hmm. And one of those is the participation rate. So all you have to do is quickly, you can do this in less than a minute, go look at how many people are considered employable, look at the participation rate, look at where it was before COVID started, take that percentage and add it to the unemployment rate that they give you.
Right.
Now they also give you 4 other unemployment rates, U3, U4, U5, U6, right? If not more, right? So those are varying degrees of unemployed as well. So you could really look at U6, which includes a lot more people than U3. And again, you kind of get to those same numbers, like 10%. Yeah. And 10% is what we see at the depths of the worst of recessions, if not worse than that. So, you got this Peter Atwater calls it the K-shaped economy, right? You got some things doing really well. Suburban real estate's doing really well. People with jobs seem to be doing okay. And then you got a massive segment of the population that's unemployed or underemployed that's not really making a lot of money, and they're struggling mightily. And this is why we have the social anxiety, why we had what we had last summer, and why we're probably going to have it again despite a different president, different Congress. It's the underlying problems are there, and they're tremendous. And like you said, the unemployment claims. So this morning at 8:30 Eastern time, the BLS puts out unemployment claims. These are people that over the last week filed for unemployment. They were just laid off over the last week or so, right? We're going to get 1 million people on that list. That's crazy.
Right. Well, and again, as you talk about, U3, U6 rates, we used to have back in the Clinton administration, we used to have what was called the U7 rate. And the U7 rate actually counted all the people that were unemployed, have tried to get employment but were unable to, and also those that have just employed what we call permanent unemployment, right? So it really actually talk about people that have been out of the workforce for so long, we just stopped counting them. They stopped using that number entirely. They retired that number because they needed the employment numbers to look better. So it immediately took 500,000 people out of the pool by getting rid of the U7 rate. But that's, we continue to kind of, mess with these unemployment numbers. But the reality is I don't think you've got to look too hard. To your point, is when you start looking at 1 million people a week getting laid off from work for one reason or the other, something's not quite right with the economy, despite the fact we're having these surging rates of economic growth, right?
Right. And it's also hard to see where they're getting employed, right? Certainly they were getting employed in the spring and summer and even in the fall to some degree. But where are they getting employed now in such massive numbers to counteract 4 million a month or 3 million a month, whatever that number is? And that's why we've seen the last two unemployment numbers net to a negative number, right?
Right.
We're losing jobs again. And, the response is just more stimulus.
Well, and
maybe there's another response.
Right. And that's something I want to talk about in the next segment is the policy response. And the reason I've got another question I want to ask you here about employment, but in the next segment, I do want to talk about the policy response. Yep. And is it the right response? And does it, really create jobs? That's really what Jerome Powell was talking about yesterday. But Jerome Powell, when he was talking about this yesterday, he was basically saying, look, the employment numbers are a lot worse than they are. And again, this is really kind of belies what we're being told, by the stock market as well, right? I mean, the stock market is booming. We're at record highs or near record highs. Companies seem to be doing exceptionally well. Earnings season's been going well so far. Companies have been beating lowered earnings estimates, but they're beating them. So, the stock market suggests that, hey, there's nothing wrong with the economy.
But go back to earnings.
Right.
Companies are not doing well. Apple and Microsoft and those companies that make up a huge chunk of the S&P 500 are doing well. Mm-hmm. Right? Just like we talk about these indices, how Apple and Microsoft are 4, 5, 6% of the index, and there's the FANGs, there's 5, 6, 7 of them, however you want to count it. It counts for 30% of S&P earnings, right? Well, there's a whole bunch of other companies that are not doing well, including those in the small caps, which are not in the S&P 500.
Right. Yet
we're seeing this enthusiasm like we've never seen before for anything. In fact, the riskier the better, right? And we were talking about this yesterday. It's not just stocks. Junk bonds are trading now at their lowest level ever. And the amount of leverage that that those same companies have on their books is ramping up at a rate and at a level we've never seen before. So the risk that the company can pay their debt, make their coupon payments, is higher now than ever. And the yield that an investor is willing to accept is the lowest ever.
Well, and just
explain that one to me, Lance.
Right. Well, that's the important thing here to understand is that everybody's like, well, yeah, yields are low everywhere, but yield, what you're accepting as your payment on a loan, and when you're buying junk bonds or you're buying corporate bonds or treasury bonds, right? The interest rate that you receive should be relative to the risk that you're taking of repayment. It's your repayment risk. And, right now we're seeing CCC rated debt. There's been a massive surge in the amount of CCC rated debt that's been issued. A lot of that by small and mid-cap companies. These are what we call zombie companies because without it being able to issue that debt, they can't survive. They would go out of business. Right. But they can do it because rates are low and because there's a huge demand by investors to buy this CCC rated debt because they're just trying to get some yield, and they're getting a 6% yield on CCC rated debt. Now, let me explain what CCC rated debt is. This is your cousin Vinny, who hasn't had a job in 20 years. He's been in prison most of that time. He comes to you, he borrows money from time to time, never pays you back, and he just showed up at your door saying, hey, look, I need to borrow some money. I promise I'm going to pay you back this time. That's what CCC rated debt is.
Right.
And that's what you're getting a 6% rate of return for. That should normally yield somewhere in the high double digits. I'm 15 to 20% type yields should be in that range because that's the risk you're taking.
Right. And there's another risk. It's also inflation. Mm. So when you look at these bonds and CCC, which, it's on the doorsteps of default, is 6%. Inflation has historically been running around 2%, right? And that's taken the government's number, right? But let's just say 2%. So right off the bat, a third of your coupon is gone to inflation. So now you're betting that defaults are going to be 4% or less, which is we've never, historically that doesn't happen. That's not the way it works. You're guaranteed to lose money.
Not in CCC territory anyway.
No. And the thing is, with this example, it's so easy to show investors how their odds of losing money are tremendous and their expected return is negative. Right. But when we turn the table and we show how stocks, these same companies, their stocks are to the moon. Right. No one understands because it just trades on some random price.
Well, and the other side of this too, though, this is a problem, and what we'll talk about after the break. But this is a problem of what the Fed has done as well by intervening into the financial markets. All these investors are like, what risk do I have buying CCC rated bonds at 6% coupons? I don't have any risk because the Fed will bail me out. And the Fed's going to buy all these junk bonds anyway at some point. So, I don't have any risk of default. If something starts to go wrong, the Fed's going to jump in and start buying all the assets up. And you know what? So far, they've been right. know. But when we come back from the break, we will talk a little bit about, so Jerome Powell thinks unemployment's 10%. He's got a solution to fix it. We'll talk about what that is when we come back from the break. Don't go away.
The lights are on, but you're not home. Your mind is not your own. Your heart's wet, your body shakes. Another kiss is what it takes. You can't sleep, you can't eat. There's no doubt you're in deep. Your throat is tight, you can't breathe. Another kiss, we saw you here. You like to think that you're immune to this.
Listen anyplace, anytime at realinvestmentadvice.com.
In a world full of financial uncertainty, turmoil, and fear, what's the gnawing question that keeps you up at night? Richard Rosso and Danny Ratliff have the answers in our next Candid Coffee Live session, Saturday, March 6th. From markets to Social Security, 401ks to Medicare. Our next Candid Coffee is an open forum edition where you set the tone, you pick the topics, and you get straight answers. Register now at realinvestmentadvice.com for Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.